Hi guys, welcome back to another video. My name is Josh, and in this video I'll be talking about 3 New Zealand travel stocks that you should be watching in this bear market. So in the past couple weeks there's been a lot of news around travel bans and people just staying at home to quarantine themselves, and that has an impact on the travel and leisure sort of industry. Okay, so in this video I'll be taking a look at some of the stocks that have been hit the hardest because of this, and yeah, talking about whether now is a good time to buy them or not. So if you enjoy content like this, especially New Zealand stock market news and stocks, be sure to like and subscribe. I heavily cover content like this, and also follow me on Instagram. That way you get updates on my public portfolio. Before we get into the video, I just want to make a disclaimer out there that I am not an authorized financial advisor. I'm not recommending you guys to buy or sell any of these stocks that I'm talking about in this video. If you need specific financial advice, do seek help from an authorized financial advisor. So let's get right into the video. Okay, so 3 New Zealand travel stocks to watch in this bear market. So the first stock that I'll be talking about is, unsurprisingly, Air New Zealand Limited. So Air New Zealand has had a very tough ride in the past month, falling about 44%, and on Friday alone, 13th of March, the stock has basically collapsed by 12.5%. Well, there's actually good reason for why the stock has dropped. The first one being guidance. So management, initially they forecasted, because of the whole situation, that earnings will be lowered to 300 to 350 million, and that was issued on the 27th of Feb. Okay, and not long after that, the company then comes out and suspends their earnings guidance. So this was a couple weeks after the initial guidance. So on the 9th of March, they withdrew their full year 2020 earnings guidance. Basically, there's a lot of uncertainty around the market, how long and the scale of the outbreak and how that would affect earnings. Management hasn't been able to quantify that yet. And looking to the business is currently in a decline, okay? And you can see that through their earnings before significant items and tax. So you can see in 2015, they were earning 464 million, and today it's down to 198 million. So that has dropped pretty much every year for the past 5 years. So not a pretty look for Air New Zealand. And you can see here as well that the fuel hedging, they've actually hedged 91% of their estimated fuel volumes in the second half of 2020, which is the current half going forward. And that's hedged at $65 per barrel. So in light of the recent crash of oil prices, Air New Zealand isn't actually going to benefit until 2021. And you can see that this is the price of oil. It's dropped heavily in the past month. And Air New Zealand will not be able to take advantage of this till 2021. So in the short term, there's quite a few headwinds going against Air New Zealand. So taking a look at their valuation, Air New Zealand currently has a gearing ratio of 54.3%. So that's quite high, okay? And their market capitalization is around $2 billion, and the trailing PE is 7.9 times. But we know now that we can't necessarily use the trailing PE because that trailing PE is based off last year, which was a normal year for them, and it was actually quite a good year for them. But going forward, because of this whole situation, you definitely won't get the same amount of earnings as you would last year. So let's take a look at how we can sort of estimate what they'll earn this year, right? So initial guidance before they withdrew their earnings guidance was for 300 and 350 million, and that's before other significant items and tax. This is based off their last year performance to guide for this year without the impact of the current situation. And then management withdrew their guidance. So for estimation sake, well, let's not assume any profit made in the second half of the year. And you know, that could be seen as conservative or even aggressive if you think that they'll make a loss in the second half of the year. Okay, and so basically earnings after tax in the first half of the year was for $101 million. And that basically gives us a forecasted PE of 20 times. Okay, so because this is a cyclical stock, you want to pick the stock when it is at an all-time low, when earnings has hit rock bottom. But I'm not sure if this would be the case, because going forward we might go into a recession, and people might cut traveling altogether even after the situation resolves itself. So I don't know if now is a good time to buy, but if the stock continues to fall further, then I will definitely have a keen eye on it. But looking at the amount of debt that they have, there is a chance that the government might have to bail them out again, like they did in early 2000s. Okay, so be very careful with this one because of the amount of debt that they have on their balance sheet. So that's stock number 1, Air New Zealand. Moving on to stock number 2 is Serko. So a lot of viewers have asked me about Serko, so I'll talk briefly on them. They are a corporate travel management tool. Okay, so Zeno is an online booking tool, and that allows travelers to use to book flights, trains, hotels, rental cars, and airport transfers in line with their corporate travel policies. And there's also an expense platform. Now, Serko's share price also looks ugly. In the past year, it's basically red, and since its highs, it's dropped about 56%. On Friday alone, it's dropped 13.79%. But it doesn't look all so bad when you extend the graph out to 5 years. You'll still be up 150% if you bought in 5 years ago. So this is Serko's commercial model. They make money when bookings are made, and that's done on a per booking basis. So they charge a fee. They also make a monthly user fee based on the number of users these corporates have on Serko. They have a supplier commission as well, where you generate revenue through commission, mobile subscription, so they get paid when someone uses their app, and also other services. So the majority of their revenue comes from this travel platform and booking revenue. And this amount here basically makes up 2/3 of their revenue, and that's quite significant because with this whole situation, this amount would decrease significantly. And that's why Serko has been hit harder than the broader market. The broader market has dropped around 20%, whereas Serko, as you can see from its highs, have dropped around 50%. As you can see here, their revenue growth in the past 7 odd years have been around double-digit growth, and it's around, on average, I'd say about 20% growth. As you can see here, very high 20s. So they have been doing really well for themselves. But based on the current trading conditions now, they do not expect 20 to 40% growth, but only at the lower end of the guidance. So around 20% they expect. The worst is yet to come, really, because the guidance was made before governments chose to close off numerous borders and suspend travel. So for example, Europe to USA. So who knows, more might come in the future, especially in Australasia. And the decisions by corporates to basically ban or limit travel will cause Serko's bookings to drop. And let's have a look at Serko's valuation. The company has a market cap of 268 million, revenues about 23 million, net profit after tax is 1.6 million. They have a net cash position and historical revenue growth of 20 to 40%. A stark contrast to Air New Zealand, this one has no debt. If you look at the valuation multiples, right, the market cap is 11 to 12 times their revenue. So that's quite high for me. And it'll be interesting to see how much more Serko will drop. If, for example, in May, they announce their results, if they guide for a really bad FY 2021, that would significantly reduce the share price of Serko. Okay, so I'm definitely keeping an eye out on this company because I feel like there is a lot more room for it to drop. Okay, so the next one, the last one I have on the list is Auckland Airport. So Auckland Airport in the past month have dropped around 21%. And on Friday, it has dropped 7.82%. In the past 5 years, however, it's basically gained about 47%. So it's still up if you bought 5 years ago, but if you didn't buy 5 years ago, then you might be wondering whether now is a good time to buy, because you can see it's dropped significantly from its highs. Auckland Airport also has revised its earnings guidance for FY20. Initially, they guided for 260 to 270, but now they've reduced it to 210 to 235. Okay, and you can see the numbers here have been dropping significantly. 3.4% foot traffic down by in January, okay, and then in February 8.6%, and in March, the first 10 days of March, 18% decline. Okay, and now they anticipate that there is a future downturn in passenger numbers for the rest of the 2020 financial year. Okay, so the 2020 financial year is until the 30th of June 2020. So they expect for the rest of the financial year a decrease. Okay, and I personally think that that decrease is going to be more significant than the first 10 days of March. Okay, and you can see the foot traffic. About 6.8% of arrivals are from China. Okay, and I think that is gonna definitely drop significantly because we have a travel ban now. And Korea as well, another country that has been significantly affected by the situation. I expect that to be down quite a bit as well. When you're looking at Auckland Airport, make sure you look at the profit after tax of the underlying profit, okay? Not the reported profit. So this gives you a true indicator of the underlying performance because it removes what you call as one-off or unusual activities like investment property fair value increases or a sale of a business here. Now, looking at Auckland Airport's valuation, they have a gearing ratio of 15.5%. So very decent, not very geared up. They have a strong balance sheet. They also have earnings of 275 million in FY19, and they initially forecasted FY20 earnings to be between a range of 260 to 270 million. So let's assume normalized earnings is 265 million. So the current market cap of Auckland Airport is $8.7 billion. And using the normalized earnings, we calculate the normalized PE ratio of 32.8 times. So Auckland Airport currently, there is more room to drop because of the further declines in number of passengers coming into New Zealand. And so I think, you definitely get to see a lower PE multiple coming in the next few months. Out of these three stocks that I've just talked about, I've already initiated a position in Auckland Airport, but I do believe that there is further downside on all three of these stocks coming forward in the next few months. So I'll be slowly building up my position in the Sharesies Public portfolio. And if you want to get updates on the Sharesies Public portfolio, be sure to follow me on Instagram. And if you enjoyed this video, be sure to like and subscribe. Please, guys, make sure you take care of yourselves. Don't touch your face, wash your hands, self-quarantine if you need to. All right, so hope you enjoyed this video. Until next time, take care.